Hello friends, we Predigo Global Research are here on the YouTube medium now. Basically, we are a global research firm which caters services to global as well as the Indian clients. We provide research on all the different parameters of the stock market across the world like US, Europe, Australia, South America, and then South African markets and Indian markets. So we as a whole decided to have a important video that we were planning for quite a long time. So this particular video will give answer to every question that a person is having right now, that whether the long term investment is good or a short term investment is good in the stock markets. We as a global research firm and our research analysts for years have been working out on these particular things, and we would like to present a small part of that in front of you. Many people say that Indian stock market or any of the stock market in the world are dependent on the patience. Basically, this is not true. This will you will find contrary to common belief that most of the people, like many Mr. Warren Buffett is saying that you invest in stocks and keep them for a while and your money would be doubling, tripling up after a certain period of time. But this common myth is about to get busted in this particular video. So let's start and understand what the global markets across the world are doing for quite a long time. It's basically long-term investments. We would be tracking the global indexes. Like, let's start with stock exchange of China. Many people say that Indian stock market is all about patience. You invest in Indian stock market and after 5 years you will get the returns. I would like to show you the graph of Chinese stock market. If you can see, in year 2000, the stock market of China was somewhere around 2300 index value, and right now it is at 2800 index value. It has just given a mere return of around 10%, or it can be said 15% in total in last 19 years. That makes approximately 1% return in one particular year. So if a person would have invested 1000 yuan in this particular index fund of the Chinese stock market, he would only have got what? 1000 1019. That is the exact amount. 1190. That is the amount he would have got. So that proves the fact that long-term investment in the Chinese stock market was not a good idea. And specifically seeing the index, we would have got the answer that this is not the right thing, which most of the people were not thinking. Many people must have thought that Chinese stock market would have zoomed in last 20 years, as it was the fastest growing economy of the world for many years. Like India has been for last 1 or 2 years, China was having this crown for last 20, 30 years, and still its stock market returns have been dubious. You can see there was small shoot of 1 year or 2 years in between where the results, sorry, where the returns were quite a lot, like they were shooting above 20-30%. But the people, those who won't have catch in at this particular time, would have been in loss. Supposedly, if we go ahead with Warren Buffett type of investment psychology in the Chinese stock markets, you would not have made returns, any returns. While if a smart investor was there, he would have taken his money out when the returns would have been increasing, like somewhere in 2008 there was a big shoot up in the returns in the Chinese stock market. Then again in 2014 there was a big in the stock markets in the 2014. So those people, those who won't have taken their money out of the table, would have been in losses or maybe at flat returns. Then we come to China. After Chinese stock market, let's come to Japanese stock market. You can see that Japanese stock market from since 1990 has still not touched its all-time highs. The index, which was 30 years back, was somewhere around 28,000, is still struggling at 20,000 after 30 years. In 30 years, Japanese stock markets have given negative returns. Can you just understand? Japanese stock market, which the most of the companies of the world, biggest companies of the world in the field of electronics, manufacturing, everything like Toyota, Honda, every company is there in the Japanese stock market, but still it is not managed to give a positive return in last 30 years. So if a person would have invested in this Japanese stock market 30 years back and would have been thinking that I would have tripled or made my money 10 times, he would still have been in losses. This is a clear case which shows that long-term investment is still not the right idea to go ahead in the equity stock markets. You have to take your money out whenever you get the profits, and you have to pull in the money whenever there is a dip in the stock market. You cannot keep it straight line. Then we come to, this is a Singapore Stock Exchange Index. You can see in January 2002 or in January 2008, it was somewhere around 3,900, and still it is not yet recovered from that high of 2008. 10 years, 11 years have gone by. Still, the Singapore, which is the biggest economic South Asian economy, is still struggling to get to the 2008 highs. So there must be certain reasons, like the stock market is not giving that returns. The exact reason is that this is a flat return market. This is a saturated market. You have got the returns in January 2002 to January 2008. And after that, for next 11 years, it is a flat market. So you can see the biggest stock market in terms of economic value in the Southeast Asian region, which the fast growing economy, which we can say that Singapore is and developing, not a developing, it's a developed nation in all, but still it is not getting any returns out of the stock market. Then we come to German stock index. You can see still 2000, it has given better returns compared to other stock market. In 2008 it was somewhere around 10,000, and right now it is at 12,000. So you can see that the approximately return since 2000, in 2000 it was somewhere around 8,000, and then again in 2008 it was somewhere around 8,000. 8,000 to 12,000, if we see, that gives a return of around 50%. So in 19 years, it has given a return of 50%, approximately 40 to 50%. So that makes a return of 2% per year. So can you just see it out, like how the differentiation in the returns can be seen in the long-term investment? Many people say that long-term investment gives 10%, 12% annual compounding returns. But if we see, and we are seeing right now the biggest economies of the world, and we are tracing their indexes, and we are getting to know that this is not the right thing. This is CAC, that is of France index. In 2000, in year 2000, it was somewhere around 8,000, and still it is under 8,000 since 2000. So we can see that it is still in negative returns of around 3,000. That makes a negative return of around 1.8% year on year. So for last 19 years, the negative returns of the France, you can see it's the biggest stock market in terms of market capitalization also. France economy is big, it is a developed nation. Still, after 2000, it has not recovered at all. In 19 years, it is still giving negative returns. This is Brazil stock market. If we compare Indian stock market with the Brazil stock market, it is somewhat similar. Both are developing economies. If we see that there was a big upbeat in 2000 till 2008 in Brazil Stock Exchange, then it touched around 75,000 levels over there, and then the slump was there. For next 11 years, for next 10 years, the whole of the stock market was in a recessionary phase, and the people, those who would have invested, were still trapped in this particular position. And after, if we see after on 2008 high, it was somewhere around 75,000. Right now it is at 98,000, 95,000 somewhere approximately. So still a developing nation like Brazil, which is having big companies under its stock indexes, it has given a return of only, if we say 75,000, 95,000 minus 75,000, that would be somewhere 20,000, 20,000 to, that would be 30% return. In 12 years, it has only given 30% absolute returns. So 30% absolute returns makes it somewhere around in 11 years. So it is around 2.5% per year. So this is a developing nation stock market index, Brazil. You must have been hearing about Brazil is a good economy. It is also a fast moving developing economy, and it's more or less similar to Indian economy, we can say it like that, but still it has given only 2.5% return. This is Hong Kong stock index. Hong Kong, the major player of Asian economy is Hong Kong. Everything related to China happens through Hong Kong. It is the main exporter or importer, or anything happens in Asia, like it is dealt through the Hong Kong economy. And the Hong Kong stock index, if you see it out in 2000, it was somewhere around 18,000, and right now it is at 26,000. In 2008 it touched and it crossed to 32,000, and then right now it is at 26,000. So if we compare Hong Kong Stock Exchange return since last 20 years, it has only been, so basis on the understanding that right now we have shared in last 10 minutes over discussing the different stock markets across the world, I, as well as our team at Predico, are stating on the record that the long-term investment is not a good idea in the equity markets as of now. We are advocating people to take short-term profits in the equity stock markets for next 5 to 10 years. So basically on this particular fact, we are advocating an analogy which is contrary to major long-term investors like Warren Buffett and many other people. So those people who advocate long-term investment are right now not considering this particular fact that the equity stock markets for last 11 years have been volatile. And specifically if we talk about Indian stock market, which has given a good return in last 10 to 11 years, we do think that a big slump in the Indian stock market is about to come in next 2 to 3 years, which will be eroding most of the capital of the people. So as an advance warning, of you can say advanced research related topic, we are giving it out that the person should be very much listening and seeing the different stock markets across the world, and then investing in the stock markets related stocks with a horizon of 5 to 10 years. If you are having that kind of horizon, you should be prepared to get negative or 0% returns also. But if you are wise, then you should be waiting for a big dip in the stock markets, as we have been stating in the graphs which were shown to you all. We can see that the common part in all the particular graphs was there was a big dip of around 20-30%, and then it was again a big up move. So a person who is investing for long-term planning should not enter in the indices or investment in the equity stocks at higher levels. They should wait patiently for 20%, 25% correction in the stock markets. This you would be getting in next 1 or 2 years, and then you can enter for a long-term horizon. That's the best way of investing that a person should do, and shouldn't follow blindly Warren Buffett type of analogy where you are seeing that invest in stock and forget it out. You should have the right entry point and right exit point. We are also advocating to book profits at small levels. Supposedly your portfolio has got a return of 10 to 15%. Take out the money, wait for a dip, then again enter. If your portfolio has got 25% return, then cash in the portfolio and then again enter at the lower levels. So that was the research part of the Predico Global Research. We will keep sharing this kind of research video with all of you. So right now, listen to this video. If you think that we have explained certain things which were not there in the YouTube medium, I guess no one would be saying on the YouTube medium that long-term investment planning is bad. But we are presenting our facts with a strong baseline of the analogy that we are creating with the world stock markets. So as an Indian investors, those who are not having that kind of knowledge around what's happening across the world, our job is to make sure that you get to know the right facts and then take care of your investments. Thank you from our side, and we hope to keep in touch, and we would be presenting much more further research reports with all of you. Keep it tuned with our channel. Thank you so much.